The action on that meme ETF, we were actually talking about it as a group, all of us, how interesting it is that it launched. What do you think that says about retail investor interest in not only the meme trade, but just risk in general?
I think actually the meme stock ETF is really intended to be a reflection of where retail investors are most interested in at any given point in time. And so what we're seeing is that the meme trade actually has come off significantly since we launched, but it's really been driven by the macroeconomic backdrop. So for the good portion of this year, investors were really kind of fueling areas of sort of high potential growth. So if I think about the themes that are in the meme stock ETF, it's areas like quantum computing, Bitcoin mining, AI adjacent stocks, and also some turnaround names like an Open Door. And a big driver of that had been the easing environment. In November, that came off hard, right? The idea that there was going to be a rate cut in December went from a near certainty to really collapsing. But now that's, of course, come back on with today's announcement, effectively baking the cake for another 25 basis point rate cut. So the rate environment is really kind of fuel to, in some ways, the meme stock fire for retail investors to continue to be adding toward more speculative names.
You know, Dave, to your point, though, a lot of people are expecting a hawkish cut today. So how does that impact just the idea of that meme trade and what retail investors are doing? Because while we are expected to get a cut, it seems almost certain. The question is really the path forward and also just the kind of the makeup of the Fed going forward. Right now, Kalshi pricing in, 3 potential dissenters with at about 50%. So a lot of questions about what happens next.
Yeah, no, I absolutely think the market needs to accept sort of greater volatility and greater amounts of dissent, both potentially on the more hawkish side and then now likely on the more dovish side, right? We know Chair Powell is effectively now sort of a lame duck FOMC chair. He has a difficult job to sort of navigate the committee in the meantime until we actually potentially see a change. At the same time, the market has sort of not rebelled against Kevin Hassett being floated as the most likely Fed chair candidate. So for now, I think the market's really, to your point, going to focus on sort of that guidance side with cuts actually baking the cake. And if we see not an too overly hawkish statement, I think that's going to add kind of, again, fuel to the idea that there could be greater pockets of speculation that really is a requirement, is lower rates are really a requirement. It turns out rates have been sort of the biggest driver of the market, even outside of the fundamentals that we've seen. And generally in this earnings season, earnings have been much better than expected.
All right, better than expected earnings. By the way, Bank of America came out with its flow show saying that clients sold U.S. equities last week, driven by retail traders, but they say hedge funds sold also. So when we're talking about the broader market, because you do have a number of other ETFs outside the meme ETF, what action are you seeing going into this Fed meeting?
Yeah, so it's really interesting, actually. We're seeing a significant amount of interest in our Magnificent 7 ETF. So that's an ETF that in some ways provides sort of the inverse exposure of the meme stock ETF. So this is exposure just to the well-known Mag 7 names. And what's interesting there is that we are seeing, to the best of our ability to kind of ascertain with ETF flows, to your point from the Bank of America survey, both sort of retail and more institutional investors continuing to use the Magnificent 7 as an area to play offense and defense. And so when we peel back the onion from that, we still see really, interesting enough, investors looking for sort of 2 things in today's market, both the potential for high growth. So AI adjacent names continue to see interest in flows, but then at the same time, a preference for safety. So if we look at broad-based ETF flows, we know there's a significant interest also in income products and what are called buffer ETFs that provide more defined outcomes. So these are really kind of a barbell approach. So investors still want to kind of take on risk in portfolios, look for the ability to outperform, but at the same time are looking for safety when thinking ahead for 2026, which is a midterm elections year, which likely brings greater volatility than we've even seen in 2025.
All right, taking on risk. That's a great topic right now. We know the SEC has addressed some of the leverage ETFs out there. You also offer some leverage ETFs. Kind of explain to me your philosophy when it comes to the ETFs, and who are these ETFs the right person for? Because some of them are like 0-day trading option ETFs, and those seem to be like a trade, not an investment, but a trade. But some of the other levered ETFs, I know some people that they kind of ride those for weeks or months at a time. I know one person particularly with the NVIDIA ETF, a lot of success, but recently a lot of volatility as well.
No, you're absolutely right. There are, of course, stories of people that have held on to leverage ETFs for some time and have done incredibly well. And on the flip side, there's others that maybe have not done so well. And the reason being is that these tools have actually been around. Leverage and inverse ETFs have been around since 2006. Single stock ETFs came to be post-COVID in the summer of 2021. These are really tools intended for short-term tactical traders. So if an investor doesn't have the ability or interest to monitor their positions and make a buy, sell, and hold decision daily, leverage ETFs are probably not the product for them. But they can be an incredibly powerful tool for investors who want to be able to use them to be able to amplify their opinions and their views on the market.
But Dave, a question for you. I don't want to interrupt you, but I know it's buyer beware when it comes to the market, but do you think there should be a limit on the levels of leverage? Like 5 times is out there, things like that. Just as you, as someone who issues, do you see not to use the same word, but do you see problems with the idea that we have a 4 times, a 5 times levered ETF? And do you think that's actually creating some of the volatility in the market?
Well, so it's interesting. So the recent SEC actions that you're referring to are really about that certain issuers filed for products that, to your point, are 3 or 5 times the return of an underlying index or an underlying security. Based off of the current regulatory framework, those ETFs effectively do not fit in. And the SEC has pushed back on the idea that certain issuers could actually amplify returns above what was codified of having exposure at 200% of what's called the value at risk, the VAR of the portfolio. And so I do think the SEC is asking issuers for more information of how are they going to comply with the regulatory framework to offer tools that provide such sort of amplified returns, again, on a very, very short-term basis. So I absolutely agree that there's a place for leverage ETFs, but perhaps sort of an environment where the underlying exposure or sort of the amplified exposure needs to fit into a framework, because the more leverage you take on, the potential for your returns to differ significantly over long time periods increases. It's just math from that regard. Mm-hmm. So I do think it's healthy that sort of the regulators are sort of trying to get more information on exactly how these products are going to comply with the framework, because the existing regulatory framework does actually work for these leverage inverse products, and they've been able to exist at 2 times leverage, particularly for single stocks.
Dave, just very quickly, we got to get out of here. Have you been contacted by the SEC at all about any of your leverage products or your income products?
No.
Okay.
We actually offer one leverage and inverse ETF on our Magnificent 7 ETF. So there's other issuers that have a wider range of leverage products.
All right.